What's up everyone, it's Scotty with Money Investing. In this video, we are going to be talking about the S&P 500. I'll share some very important insight with respect to the broad-based equal weight ETF RSP. The S&P 500 give you a little bit of an earnings update. How well are we doing in this earnings season? And then also go over some of the very important technicals for the markets as well. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, link to our Discord and Patreon is going to be down below if you're interested in joining. Of course, getting access to all the buy and sell alerts, options alerts, trade ideas. I will be updating our spreadsheet, the watch list, and be calculating the intrinsic values for a lot of those companies this weekend. So if you, again, want to get access to all that, educational videos, a lot of private videos, links going to be down below, and we'd love to have you on board. So first things first, let's talk a little bit about the S&P 500 and the earnings season that has just begun. Overall, 18% of the S&P 500 companies have reported actual results, and 75% of those 18% companies have reported actual EPS that is above the estimates, which is slightly below the 5-year average of 77% and above the 10-year average of 73%. And on aggregate, companies are reporting earnings that are 6.4% above estimates, which is slightly below the 5-year average of 8.4%, but equal to the 10-year average of 6.4%. Now, there's also been downward revisions to EPS estimates for companies in the healthcare sector, offset the positive earnings surprises reported by companies during the week. So there's been a lot of decreases in earnings expectations, and as a result, the 75% number, which is, again, the number of companies out of the numbers that have already reported that are posting exceeded expectations and exceeded numbers, may not be actually accurate because of the downward reversions in EPS as well. But the more important number to look at is the blended growth rate, or estimated results for companies that have reported earnings decline for the second quarter, is 9% today, meaning the blended earnings decline for the second quarter is minus 9%, compared to an earnings decline of 7.2% last week and an earnings decline of 7% at the end of the second quarter on June 30th. If 9% is the actual decline for earnings for the quarter, it will mark the largest earnings decline reported by the index since the second quarter 2020, minus 31.6% back then, and will also mark the third straight quarter in which the index is reporting a decrease in earnings. So when people say that earnings are resilient, I don't know what they're looking at, because we are still expected to report a decline on a year-over-year basis. As you can see, the forward 12-month P ratio 19.5, which is above the 5-year average of 18.6 and above the 10-year average of 17.4. And then above the forward P ratio of 19.1 as well. And during the upcoming week, 166 companies, S&P 500 companies, are scheduled to report results for the second quarter. So obviously, we're going to get a lot of insight into the earnings growth. And it's really going to come down to big tech. And it's really going to come down to discretionary and comm services. And can those companies actually lift the earnings growth for the S&P 500? Because right now, as I said, in the second quarter of 2023, we're expected to see a decline of negative 9%, which will be the third straight quarter, which, theoretically on paper puts us in a earnings recession. But obviously, the markets are not trading like we're in an earnings recession, and the market sentiment obviously is also very positive as well. So consumer discretionary so far, 31% growth in year-over-year basis. Comm services over 13%. So we're getting a huge rebound there. Industrials up over 7.4. Real estate up over 7.3. IT, which is information technology, down 3.4. And of course, the biggest losers are going to be healthcare, materials, and more importantly, energy. Energy was one of the sectors that we mentioned. I literally talked about it in December of 22, that energy would be ripe for some shorting opportunities, for some downside, because of how much energy prices have rolled over. And as a result, these energy companies will have to comp over some very tough numbers, and they will not be able to meet expectations. And as a result, would be open to vulnerability and of course, potentially selling off in the future as well. So energy, has been down. It has been selling off. XLE, you'll notice it is from its recent highs, it was down a little bit over 19-20%, but now it is now starting to see a little bit of that momentum back higher. Year to date, still down 3%, so very significantly underperforming. But this week, it's up over 3.5%, which brings me to my second point. But before we get there, this right here is something that bar chart posted. The S&P 500 is experiencing its longest earnings recession since 2016, where we have seen 3 quarters, and potentially we'll see even the fourth quarters in a row, which will be the third quarter of 23, to also see earnings decline on a year-over-year basis. So that's the S&P 500 EPS growth on a year-over-year basis, 4 consistent quarters of potentially declining which again, theoretically on paper puts us into an earnings recession, but obviously the markets are not into that right now. So this is something that I mentioned in one of my other videos, which again, I consider to be very, very important, because what we really witnessed back, in the beginning of 2023, and of course, up until a few weeks later, is that technology was the leader. It was rallying a lot, right? So it was the one that was actually pushing higher, pushing the markets higher, and X technology was flat. Right? So we were slowly and steadily kind of drifting higher. We were seeing very nice gains, S&P, NASDAQ up 18, 20, 30, 40%. But I also mentioned for the markets to be up a lot, we would need to see a broad-based rally, right? We would need to see technology and X technology, both of them need to rally a lot. If both of them sell off, of course, it would be a broad-based sell-off as well. But if one of them rallies, other one sells off, and if one of them rallies, other one stays flat. Again, any combinations of those two will basically result in these market scenarios. So now I think we're in a scenario where we are seeing technology sell off. We're seeing a bit of a pullback and a dip in technology, and X technology is starting to rally, right? So we're really seeing this scenario right here. So let me just mention that. This right here is a scenario that we're witnessing, in my opinion, which is a potential sell-off in tech, a little bit of a rally in other sectors, other parts of the market. So we're seeing a bit of a rotation, but the markets are still down a little bit because of the influence and the weight that technology has on the S&P 500 and the index overall. So that's where we are. And I've got data to prove it. So this right here is the S&P 500 up 17.7% year to date. But if you take a look at RSP, which is the equal weighted index, this up until a few weeks ago was up a measly 1%. It was only up 50 basis points to 1%. Year to date now, it's up over 8.5%. So it's made a lot of ground. It's covered a lot of ground because equal weighted index means every single stock is going to be valued and weighted equally in this ETF. And since other sectors are now starting to participate, what we're really seeing is a pretty significant rotation out of tech over to other parts of the market. And this right here, I can promise you, no one's going to show you this chart. This is a very, very important and yet interesting chart, which I'll go over in just a minute. But if you come over to this right here, the last 1 month, you'll notice XLE up over 7.2%. We've got XLF up over 5.99, almost 6%. XLI, which is your industrials, up 5.5%. Mining ETF up 5.3%. Real estate up 4.8%. XLB, which is, I believe, materials. Yep, materials up a little bit over 4.4%. Utilities, folks, up almost 4%. And guess what's not working in the last 1 month? Technology. XLK up only 2.5%. It's trailed energy, materials, financials, industrials, utilities by a significant degree. We got staples, we got discretionary, we've got healthcare. Those are the sectors that are tracking or trailing behind right now, underperforming over the last 1 month. And that simply means what? Rotation. Rotation is what's happening at the moment in the market. People taking a little bit more of a risk-off stance, moving out of tech over to more other sectors in the market. And this right here is a chart that basically goes over RSP divided by SPX. So that's your equal weighted index divided by the S&P 500, which is market cap weighted. And what you will notice is that every time this chart goes up, that means the equal weighted index is outperforming the market cap weighted S&P 500. Okay? Again, I want you guys to think about it logically, right? What does this actually represent? When this chart is going higher, you've got the equal weighted index outperforming. And that's exactly what happened in 2020, in 2021, when we were witnessing, of course, a lot of energy and defensive stocks push higher. Of course, there was a lot of tech involved as well, but then tech started trailing sideways because Netflix, Amazon, Tesla, we did see them rally quite a bit, and then they started trading sideways, and other sectors caught up to those rallies. But then this right here is going to be 2021, where tech absolutely dominated. Tech did really well. Google, I remember, was up 60% on that year. So tech was doing really well. And this right here was, once again, the bear market of 2022. November 2021 is exactly when this started, all the way through January of 2023. Energy and defenses were the place to be. And they did really well against technology. And then, of course, markets turned once again. Cyclicality and rotation took on. And we had technology rally quite a bit because you've got the S&P 500 outperforming the equal weighted index RSP. That's why it's going down. So RSP is underperforming the S&P 500. So we did have, since the beginning of this year up until now, we saw technology rally quite a bit. The real question, what's going to happen now? Are we going to move higher for RSP, which is the equal weighted index? Because as you can see, if I zoom in a little bit, the last 3 to 4 weeks, we have seen some outperformance, right? Last 1 month, as I pointed out, there's been a lot of rotation into energy, industrials, materials, utilities. And as a result, equal weighted index is performing better than the S&P 500. That's why it's caught up from 1% to 8% year-to-date gain. And the S&P 500 is pretty much flat. It's not really moved much. So that's something that's really we need to pay attention to. And this, again, I want to make sure that we are not kind of, getting too tactical in a sense that we are moving away from the overall market in general, because the odds are still very much in our favor. The probability is very high for the markets to be green this year. This is a chart that I mentioned earlier in one of my other videos. And if the S&P 500 closes for 5 consistent green months, the probability for us to see higher gains in the next 12 months is very high, over 93% probability the market's going to be higher 12 months from now after the S&P 500 is up 5 months in a row. So that is very important. And then another chart that goes over from Charlie Bilio, shout out to him, posting basically the returns for the first 135 trading days. And S&P 500 so far is up 18.6%. And as you'll notice, price return for the full year, every time the S&P 500 has seen a very strong first 135 days, the probability for the S&P to be higher for the entire year is really, really high. So if I do the calculation here, we've got 1 divided by 14. So we're looking at, let's see. So, so we've got 15 over here. So only once have we seen the S&P 500 basically down. So that's less than 6%. So 94% of the times we've seen the S&P 500 higher for the entire year, once we've seen very strong gains for the first 135 trading days. Now, I'm not saying that's going to happen in this year as well in 2023, but the probability is very, very high. So where does that leave us? Well, simple assumption. In my opinion, 96% probability, 94% probability, the market's going to be higher for the entire year. So 2023 will probably, most likely, in my opinion, considering the probability and the odds, we're going to close green, and we're going to close green well in the double digits, mid-teens, high teens, possibly in the 20s as well. But in my opinion, the second half of the gains may not come from technology. Okay, it may come from maybe some of the other parts of the market, considering the valuation and the risk-reward dynamics. Technology has already run its course, at least in my opinion. Even though I'm very heavy tech, it's something that I have to understand and be aware of and share, because you've got NVIDIA trading at 40 times sales. How much more upside does it really have to carry in the second half of 2023? So, like I said, I'm still going to dollar cost average into the S&P 500 more broad-based ETF. Still going to continue to look for deals in individual stocks and sectors. But I do believe the second half of this year is going to be mostly dominated by some of the other sectors out there that have really been underperforming so far this year. And we will get a little bit more broad-based participation from different sectors and stocks as well. So that's where I believe the market's potentially headed. Let me know your thoughts down in the comment section below. We've already started to see that in the last 1 month. As I pointed out, other sectors are pushing higher and tech is kind of trailing behind a little bit in the last 1 month. And that's simply the rotation that we're seeing away from tech over to other parts of the market. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.